If the scheduled news is anything to go by, then the coming week could be relatively quiet, but appearances can be deceptive. After all, the latest edition of the St Leger horse race is due to be run at Doncaster's Town Moor track on Saturday the 11th of September. The running of the final so-called classic of the flat racing season is often seen as heralding the end of the summer lull in stock market trading and a return to higher levels of activity, as per the old saying, sell in May, go away, and come back again on St Leger Day. Make of that what you will, but the latest Chinese inflation figures on Wednesday the 8th of September and US factory gate or producer price inflation numbers on Friday the 10th should be informative. They may have central banks on high alert as the debate over whether the current spike in inflation is transitory or not continues, and the main macroeconomic item of the week could just be two interest rate decisions. One from the Reserve Bank of Australia, the RBA, on Tuesday the 7th, and one from the Bank of Canada, the BOC, on the 8th. The RBA's current headline interest rate is 0.1% and the BOC's is 0.25%. What makes this interesting is that the BOC is already tapering its quantitative easing or QE scheme, and the RBA is due to start tapering in September, so they're already gently tightening monetary policy, albeit from very loose levels. Moreover, South Korea and Iceland became the first developed market central banks to raise interest rates this year in August, after a slew of hikes from emerging markets like Brazil, Russia and Mexico. The moves from Korea and Iceland took the total to 46 rate increases in 2021 from central banks, compared to just 8 cuts, a massive shift in momentum from what we've seen in previous years. All of the central banks who've moved this year have generally been looking to nip inflation in the bud, whether it's price inflation, house price inflation, or even asset prices more generally. So it'll be interesting to see whether the RBA and BOC make any mention of this, even if the Reserve Bank of New Zealand postponed an expected rate rise in August, citing an outbreak of a new COVID variant in the country for the reason. Now, the US Federal Reserve, Bank of England and European Central Bank are all still debating tighter policy and sort of pretending to be talking tough, but as we can see, some monetary authorities are actually getting on with it. The key now will be whether the bigger banks follow, or whether the early movers have to stop and reverse track, which is what happened on more than one occasion in the past decade. On the corporate front, not one FTSE 100 firm is scheduled to make an announcement in the coming week, although a good number of mid and small caps are due to update shareholders on trading, either with their first half or full year results. Names which may be worthy of further note because of what they say about themselves, their industry, or the economy more generally include the following, although these dates could yet be subject to change. Estate agent Beaver and Decra Pharmaceuticals on Monday the 6th of September. Cleaning products expert McBride, house builder Vistry, and niche building materials firm Alamask on the 7th. Retailer Inspecs, Gamma Communications and chilled foods producer Bakkavor on the 8th. Bid Target and grocer Morrison's, broadcaster STV, litigation funder Burford Capital and transport specialist First Group on the 9th, before Sussex-based engineering services firm Ricardo closes out the week on Friday the 10th of September. But the stock which could just cause the biggest fuss in the week ahead is soft furnishings and homewares retailer Dunelm. The FTSE 250 index member is slated to release its full year results to the end of June on Wednesday the 8th of September. The company's business model proved ideally suited to the pandemic and lockdown blighted year of 2020, as its website kept customers served, and those customers spent money on their house which may have otherwise perhaps gone on holidays or other items. However, investors' affections in 2021 have, so far at least, switched to those firms which may show a faster recovery in profits and sales going forward, if only because their business model took such a big hit during the worst of the viral outbreak. The upshot is that Dunelm shares are down by 15% over the past 12 months, and they've actually made little progress this year, calendar-wise, despite some very upbeat trading updates, the last one of which covered the fourth quarter and came out in July. When Chief Executive Officer Nick Wilkinson revealed, sales for the whole year rose by 26%, with the fourth quarter up by 102% as physical shops reopened. For the year, digital sales reached 46% of the total, although that had slipped to 37% in the fourth quarter as shoppers got to, go to the shops again. Gross margins rose owing to the postponement of the traditional summer sale, and ultimately pre-tax profit would reach £158 million, slightly ahead again of analysts' forecasts. So when it comes to the full year figures, analysts will be looking to those benchmarks and indeed any guidance for the financial year to June 2022. 3 figures are likely to grab the headlines. The first is sales. Dunelm has already flagged that 2021 revenues will come in at £1.3 billion, so analysts will look for any comments on first quarter trading 2 months in and any forecasts for the year to June 2022. The current consensus is for a 5% increase to £1.4 billion. Second headline number is profits. Again, Dunelm has already revealed that its gross margin rose by 1.3 percentage points in the year to June, implying a figure of 51.6%. But it has also already flagged a dip of 0.7 to 1 percentage points in the coming year due to the timing of summer sale and also input cost pressures. That contributes to analysts' forecasts for only a minor increase in pre-tax profit in the year to June 2022 to £163 million against £158 million just booked. And the third key figure is the dividend. Dunelm's balance sheet had net cash at the year end according to the July trading statement, and the firm returned to the dividend list in February with a 12p a share payment for the first half. For the full year, analysts are looking for 33p a share, with a further increase expected for the year to June 2022. Note also that in the past, Dunelm has paid out special dividends and launched share buybacks for good measure. More strategically, watch out for any further comments on supply chain disruption, cost or price increases, and plans for investment in both digital capability and warehousing space. Dunelm is breaking new ground on new warehouses in Daventry and Stoke, sites expected to cost £12 million and also add £8 million to operating costs in the year to June 2022 as they get going. I hope that you and your families are all in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.